Welcome to Warwick Business School's Core Insights podcast on fintech. This is the sixth in a series of podcasts on fintech with the school's Gillmore Centre for Financial Technology. If you're new to this series, what we're doing is, together with the help of the centre's world-class researchers and professors, and alongside some fantastic guests from the fintech industry, we're exploring the really big issues as the financial sector continues to be disrupted by exciting new technologies. I'm Natasha de Teran, your host. I'm a former financial journalist and the author of The Payoff: How Changing the Way We Pay Changes Everything. Today, we're going to talk about something else, or maybe some overlap. We're tasked with establishing how blockchain is about to revolutionise banking. I think there's an if in there, but let's go with how for the moment. To answer this, I'm joined by Ram Gopal, Professor of Information Systems and Management at Warwick Business School and the director of the Gillmore Centre. And I'm also joined by a fantastic guest, Martin Walker. He's the Banking and Finance Director at the Centre for Evidence-Based Management. So, shall we start with what we mean by blockchain, just to sort of level set?
I guess the terminology gives itself away to some extent, right? So a blockchain is fundamentally nothing but a chain of blocks. So the question is what goes into the blocks and how the blocks are constructed. So that's where the magic happens.
It's a database technology.
It's essentially a distributed ledger technology.
Distributing data.
Distributing data. Well, it fundamentally distributes blocks. Now the question is what the blocks contain. More often than not, it contains data, but it doesn't have to. It can also contain software code. And that's the foundation of what we call smart contracts.
The one thing I would add is there's the strict technical definition, which Ram gave a perfectly accurate one, and there's what I'd call like the marketing commercial definition, which originally was based around not just the management of data, but basically a set of things that the original Bitcoin underlying technology was doing. I think, as we discussed, one of the things we have to bear in mind is that that term blockchain has come to cover a much wider range of different technologies. In some cases, they've added functionality, like the functionality around smart contracts, and the programming level of programming you can support has greatly increased. In other areas, depending on the specific type of blockchain or distributed ledger technology, they've taken away a lot of the original features around decentralization, even blocks in some cases. some of the so-called blockchain type technologies don't actually process data in blocks anymore. So I think that's one of the things you really have to take into consideration when you're evaluating questions like what's the impact of blockchain on banking, because it has come to mean a very wide range of technologies. And occasionally you get some of those vendors referring to their technologies as blockchain inspired, because it has actually dropped so many of the original features that you found in the original Bitcoin implementation of blockchain type technologies.
But blockchain and Bitcoin are separate things. So there's the technology of blockchain.
Well, separate things, but I think when people have been talking about blockchain, especially when it moved on from blockchain type technologies as an enabler of cryptocurrencies, there was always a set of technological ideas, many of which weren't actually very new, that were underlying Bitcoin, and that in many cases those technologies underlying Bitcoin have been carried on to varying degrees and used in subsequent technologies that have come along, like Ethereum, Corda, etc.
So Rom, if I was a young student, and difficult to imagine, but if I was a student at business school, I might be reading what's going on, and I would see that JP Morgan has been playing around with blockchain. It's bypassed SWIFT in India. I would see that, well, pretty much every financial institution, but just to name a few. There's been Nasdaq recently, BNP, and many others. Would I be right to think that my future in banking would best lie in researching or studying blockchain? Is it going to be that disruptive to the banking system?
What I would say is that I would not discount blockchain technologies as playing a prominent role in the future of banking. So you asked the question of, is blockchain going to revolutionize banking? And the question was if or and in my mind, the question is not really if or how, right? To me, the more important question is when. And I think what we are witnessing is birthing pains. And with any technology, it's not just the technology itself, is the systems and processes that surround the technology that make it successful or not. I think with the blockchain technology, the technology itself is actually quite simple. I teach blockchain technologies in my MSc course, and it takes all of an hour to make students understand what blockchain technology at its core is. The challenges are around the processes and the ecosystem in which the technology is supposed to make an impact. And those things are lagging behind. So I think as far as students are concerned, what I would ask them to do is to understand the technology, understand the banking and more broadly financial services, and begin to map out where the pain points are. And those, to me, are the opportunities for the future.
That's interesting. In particular, you mentioned ecosystem. And when we look at the financial system, it is made up of many different interlocking, intersecting, clashing ecosystems, all of which are, have interested parties governing them, playing in them, owning them, controlling them. Whether these are jurisdictions with legal interests and governance interests, whether they are commercial organizations with maybe financial interests or simply governance interests. None of this goes away when we move from one technology to another, unless we presuppose that we're all going to subscribe to a new technology and form of money like Bitcoin, which is maybe somewhat far-fetched.
Yeah, I think, on that, Natasha, one of the ironies of blockchain technologies is that it works when you have parties that don't necessarily trust each other. But the lack of trust amongst the parties is what also hampers the adoption of blockchain. I think that's a fundamental conflict that we have.
When we look at the history of a lot of the writing around blockchain, it's typically come from definitely from a technology background, maybe not such a financial background. And it's quite often come from a libertarian standpoint, somewhat imagining this new global coalescence around a single philosophy and set of governance interests, which I don't know if you want to comment on that, Martin.
I think it is actually really interesting how things have evolved from that original vision. Going back to the main question of when, if blockchain will transform banking, we've actually had quite a number of years now of various attempts to change banking. I mean, the Bitcoin blockchain went live in 2009. What I'd call the enterprise blockchain, which was basically going to remove all intermediaries. It was going to be a totally different world. That just hasn't happened at all outside. Even in the crypto world, that just has not happened. And you've created a whole new range of intermediaries, governance, and hit into a whole bunch of regulatory things because you cannot just exist outside of normal law and regulation. But
we shouldn't really be surprised by that, should we?
Well, I wasn't, but a lot of people were. But then moving on to
disagree on very much. It seems surprising that someone would think that.
Well, I think part of it was a lot of the early pioneers in blockchain, cryptocurrencies, etc. They had a lot of very strong ideas about how banking and money worked, but they actually had little practical experience. And that's not to say that you have to be an old fuddy-duddy who's actually who believes in the way finance and finance technology works to actually be able to solve problems. But what I think a lot of those people were missing, who had very strong opinions about things, was because they didn't have the background, they didn't, going back to Ram's point about the problems and understanding the problems, they didn't really have an understanding of the problems that needed to be solved, including the problem of how you actually operate within regulatory and legal constraints. I think then since about 2014, you've had the whole enterprise blockchain thing, where I think you've abandoned cryptocurrencies, you've got private blockchains, which are almost like centralized systems. But I think one of the interesting things about that is that in spite of all the press releases, etc., none of it has actually done anything to tangibly remove intermediaries or change governance structures at all.
Of course, a lot of the press releases come from the intermediaries themselves. So
no, they do. You have intermediaries who are pursuing blockchain type technologies now. And one of the interesting things I find when I go to finance type conferences, which I do quite regularly, is everyone is talking about, first they were talking about blockchain, then digital ledger technology. Now they talk about digitization. No one really talks about removing intermediaries. And it's actually intermediaries who are actually behind, whether they're banks, securities depositories, other types of intermediaries are pursuing blockchain and DLT type technologies. So that's interesting that it's actually sort of fitted into the existing world, which is both existing within these strong regulatory constraints, but at the same time is rather fragmented and is also hard to change because of the number of dependencies within the financial ecosystem you have.
Yeah.
Systems talking to each other.
Can I just add a little bit on this, the whole notion of disintermediation, right? What I would say is that when it comes to disintermediation, the story is not over yet. The fat lady has not sung yet. That's my belief. If you take a look at Bitcoin did disintermediate to some extent, right? Money transfer. Now, the problem is that it replaced one form of disintermediation to another form of disintermediation, which is basically exchanges, right? Now, that is just, again, part of the journey. And now there's a lot of research that's going on, including at the Gillmore Centre, that is looking at, can we actually decentralize exchanges themselves? So I think this movement towards decentralization is something that will continue. It may take different forms. The notion of intermediation may shift from one party to the next party, but eventually I see that as the direction of travel. How far we get and when we get there is another question altogether.
So one of the arguments for disintermediating the incumbents of different kinds is a financial one, that there's too much of the consumer's money is being chewed up upstream in the system by fleshy organizations. There's another one, which is a more libertarian one, which is that we need to get away from control and that we don't want to have anybody at the center. It's all going to be governed nicely. But at the end of the day, there has to be a consensus, which requires a group, which requires a mechanism for consensus. And I don't mean an algorithmic one. I mean, the form behind that, if you like, the codification of that. But you also need, if we're going to talk about smart contracts, we need some agreement on how these are going to work in time, and we need limitations, who's allowed in, who's not allowed in, the what's and wherefore. So it seems to me that you might disintermediate some of the profit chewing folk, but in terms of the response, the legally responsible and therefore slightly profit chewing people will come back. And there will also be a central authority of some kind, even if that authority is more of a virtual one than a real one.
Well, yeah, I think trust is fundamental to finance, right? So the reason we have this large incumbent organizations is because people trust them over a period of time. So that actually makes sense. So I guess the question is, the pendulum has swung too far, in the sense that the big banks have become too big to fail, and that creates problems for the entire economy. So that's the fundamental drive behind the move towards disintermediation. In a sense that having no intermediary of any kind anywhere in the system, that's probably an utopian dream. I think what is more realistic, perhaps, is to have you do have to trust some entities, whether physical or virtual or human or AI, at some level. But the move is towards trying to make the system less dependent on those entities. I think that, to me, is the broader move towards this whole crypto and blockchain and Bitcoin.
So some of the banks are too big to fail. Maybe all of them are systemic at the end of the day. And we found small ones in Silicon Valley turn out to be systemic when we didn't even know they were there. It seems to me, though, but they're behind these banks are much bigger organizations, so they're impossible to fail. If banks are too big to fail, what are the cloud providers? Because all of this is happening in the cloud. Are we giving up one ill for another ill?
The too big to fail is a problem, especially in banking, which has got to become a lot. It's not just that the systemic impact of one bank failing seems to be more traumatic now, but it's also the banking sector has become a lot more concentrated, which is something that the regulators and the central banks are very aware of and might have tried to encourage with varying degrees of success challenger banks. That's not a good trend, the degree of concentration. But I think the cloud provider point is actually even more worrying, just in terms of like the sheer degree of concentration. The cloud technology is actually dominated by about 3 cloud providers globally. And there's the concentration risk of what if one of them fails, financially, technically, whatever. But then there's also the concern about monopoly power, because cloud really started out as an economic driver. It's like, let someone else do this, get economies of scale, and it's cheaper. Now, the various cloud providers have added a lot of wonderful tools to actually allow you to build cloud-based applications which are more elastic and all of that kind of stuff. But they come at a price of lock-in, and you can see that that very small number of cloud providers are trying more and more to actually lock in their client base, which is actually bad from a competition perspective, but it's also bad from a systemic risk perspective in terms of just having such a concentration on such a small number of companies.
And does blockchain make that any worse, Ram?
Well, the ironic thing is so many of the blockchain servers, nodes, especially the enterprise ones, they're all running on cloud. They're all running on cloud providers. So you could argue about how real decentralization is in enterprise blockchain, but they had certainly centralized again when it comes to putting them all on the same small number of cloud providers.
Right. But in a sense that, I mean, I completely agree with what Martin is saying, in the sense that whether it's decentralized or centralized or what have you, at the end of the day, all the data is sitting in the cloud, which is owned by three major organizations. Okay, that is a problem. This notion of centralization, decentralization is not unique to financial services. It's also there in the tech field. And what I find really fascinating is that a lot of the trends in generative AI. This
is ChatGPT.
ChatGPT and all its derivatives. They're all aiming towards what they call democratization of technology. So the movement we're seeing in financial services with crypto and Bitcoin and blockchain, something parallel is also happening in the tech sector.
Do you see that all of that really leading to more democratization, given the centralization?
Well, I think it's not a 0-1 question. And I think parts of technology will become more democratic. Similarly, part of financial services will also become more democratic. I don't think we'll ever get to a point where everything is completely disintermediated in financial services. That is simply not feasible, because at the core is this issue of trust. You have to have trust in some entities, physical or virtual. I guess the key moment is to minimize the amount of trust you need to have, and put them in technologies, put them in organizations that are not as critical for the survival of the entire economy.
I just want to ask one question on your use of the word democratic. Do you mean by that accessible, as in accessible to the least financially attractive customer, the poorest? Or do you mean in terms of governance? Because those are two, or do you mean both?
Actually, it's both. In terms of giving access to the technologies to around the globe, to people who are financially not as strong as the rest of the world.
Who are very expensive to serve.
Right, that's one bit of it. And the other bit is also around governance, control over the technology itself and what shape the technology takes. And in the tech sector, we have a very vibrant open source community. So in fact, even in the generative AI space, open source models, a lot of momentum. And in terms of performance, more and more they're coming close to what GPT-4, which is controlled by OpenAI, can do. So there is this movement that is trying to democratize technology, both in terms of access and also in terms of governance and control.
Behind all the governance and control that there is today are governments, and governments quite like control. Not always for bad reasons. I mean, they're charged with ensuring peace and prosperity in their nations, and money is quite fundamental to that, and so is the financial system. And they like to have a hand in what that financial system looks like and who's doing what within it. And from that, you get a lot of control through the large infrastructures or the large banks at the moment and so forth, that intermediaries that are in the system. The move to blockchain and to this future is not going to change any government's desires, I don't think, to have the same control in the future as they have today. So that democratization idea does have its limits, because it's going to be democracy my way.
Right.
If I'm Uncle Sam.
That is certainly true. In fact, in the financial services, the whole crypto movement is really about disintermediation. And it's not necessarily about trying to circumvent the regulation or the law. It just so happens that the way Bitcoin works, it can also circumvent the laws, circumvent all forms of regulations. So I think the future is going to be some kind of ecosystems within which blockchain type of technologies will operate, which will still disintermediate, but at the same time they are in compliance. And I think that's what we'll see more and more.
One of the key things I'd add is you need to look at why intermediaries exist, and they exist for different reasons. In some cases, they are literally just another layer of rent seekers.
Just because they can.
Just because they can, because the system's grown up the way it has, because they have lobby groups and they can lobby to have the regulations not to damage their business models, etc. And I've written about that in some of my research. So yes, there is bad intermediation, which is just the net cost. But then you also have intermediation, which comes because it's from carrying out a specific commercial activity, which is difficult to do without an intermediary, like credit intermediation, credit creation, managing liquidity. These are things which are very hard to do without actually having an intermediary. And it's quite interesting watching the struggles of the DeFi sector to try to achieve that. And then you have the intermediaries, which is actually more about trusting your governance framework, trusting you to be the witness to what's going on in transactions, like the CLSs, the SWIFTs, etc. They're not an intermediary per se in terms of scooping a big chunk off of the actual cost, because if you look at things like SWIFT and CLS and even some of the CSDs, they're not actually that expensive in the big scheme of things, but they are providing that governance and that centralization to actually just make sure things are actually working in a structured way, and you've got standards, etc. So you do have to look at why intermediaries exist, and in the context of things like blockchain, whether it's public, private, whatever, what people are trying to build with those technologies, in what ways that's actually trying to remove an intermediary or the need for intermediary. But so I think you really have to look at it that way rather than just talk about intermediaries per se.
And I think you mentioned too there that I would call infrastructures. I mean, you could call them both, but they're infrastructures and intermediaries. And that brings me into what they're sitting as infrastructures around, and that is disparate markets. In CLS's base case, it's currencies, and in SWIFT's largely as well.
The thing is, these are the things which actually make decentralized markets work. Is a decentralized market, but you rely on SWIFT and CLS to pull it all together.
Indeed, and in their cases, it's different currencies and different jurisdictions and different banking entities that they're joining together. But they're joining together the different banking entities, at least in their international, foreign exchange contexts. They're joining them together across borders. So what they're joining together is intact currency zones, if you will. And what I want to ask you, Ram, is when we have things on the blockchain, and we have to imagine there's not one single blockchain with absolutely everything on it. I mean, let's imagine we're the UK and we have an equity market, a debt market, government bond market, credit market, repo market, all these different markets. So let's imagine in the best possible case, there's one chain for each of those things. The thing is, we move value across and between. So we end up as UK citizens needing to do in the UK what cross-border we're doing with SWIFT and so forth. Are there not going to be intermediate or infrastructures connecting these chains, or are you imagining that the chains are going to talk happily to each other to allow the simultaneous exchange of, bonds for equities?
It's not that they necessarily need to be intermediaries that connect different blockchain systems. It's more a protocol issue. So it is something that can be coded in, where one blockchain system can then work with another blockchain system. In fact, there are quite a few protocols being discussed. Most of them are still in the research stage. But fundamentally, the question is, how do we create algorithms, protocols to ensure that different blockchain systems can actually communicate and work with each other?
And do we need money on the chain, value on the chain? Do we need pounds on the chain to make all of this really worthwhile?
That's the million-dollar question, right? When you have a blockchain type of technology, one of the fundamental issues is that who gets the rights, who gets to control which blocks are added to the chain. At the end of the day, someone has to make that decision, and that decision has to be something that everyone else will agree on. And the whole mining industry, the Bitcoin mining industry, essentially developed because because of the incentives that one has to give for people to mine. And thus Bitcoin was born, essentially.
Mm-hmm.
And so there has to be some kind of incentives that are offered in a decentralized system for everyone to participate and play fairly.
And the actual, Martin, moving to the money itself, so the pounds,
Yes.
Whether commercial, central, or in coins. If we have these different markets on the chains, as I said, bonds, repo, equity, and so forth, do we need to have a tokenized form of money to make the chains really useful?
Looking at the experience in enterprise blockchain, many of the enterprise blockchain concepts have really struggled to get beyond a certain level because money isn't on chain per se.
Money is old-fashioned money, fiat money.
Old-fashioned money isn't actually on chain, which makes it very hard to do things which the current system actually does very well and relatively easily, like delivery versus payment and payment versus payment. So that's a real block to that whole world advancing. But you're quite right, we're not talking about one chain. That you still get people who say put stuff on the blockchain and so there's one thing, but that's just never going to happen. So you do end up in this world of many different systems. You can call them blockchains, but they're systems, and you have to build interoperability. And again, you have to look at the existing world. How does a CSD achieve delivery versus payment? It has
a central securities depository.
Central securities, but it has a cash account and it has a securities account. Maybe there's a connection to the central bank as well, but it can actually do that synchronized exchange of cash for securities, which is technically more straightforward if it's centralized, but also from a governance perspective and from an operational resilience perspective, it's under one party's control. One regulator can actually look at that. If you are talking about multiple different chains with interoperability layers, and I do take Ram's point about the people trying to build protocols, but also there's blockchain companies building interoperability software to make blockchain and additional layers of software. It's just harder to control, harder to regulate. And as things stand with this fragmented blockchain world, it's actually there's significant challenges just technically implementing it compared to a more centralized technical approach. But we have to see how things progress.
So overall, you're sounding a bit more skeptical than Ram. Ram's headline is when rather than if or how.
Well,
and you're more on the if, is that right?
There's an element of if, and there's a big element of how much. So you've seen these type of technologies working in niches. I talk to people in blockchain companies, and most of them are or in blockchain teams, and most of them are actually sort of resigned to this will work in niches. It's not going to change everything. It's as much about not just if, but how much. And I think people have been making very, very big claims about blockchain, public, private, crypto, etc. for quite a long time now. And you do have to actually look vigorously and objectively as much as the data allows on how far things have come and the challenges that either are still that the challenges that are there in the nature of the technology that people are still struggling to overcome all these years later. A lot of that is because things do move slowly in terms of financial market infrastructure. You have to be fair to that, and conventional systems using projects using conventional technology fail all the time. So you can't just say it's you've had all these big failures, which you have had some very big failures in the blockchain world, and that proves it doesn't work. But still, there's been a significant amount of time to actually judge this, and my judgment is it's not easy to actually roll this out on these type of technologies on a bigger scale outside some specific niches.
Yeah, but the financial world is full of niches. As we've discussed, you have things like CSDs and SWIFT and CLS, and you have the currencies, and then you have this, and you have that.
Niches within niches.
Yeah, and then you have niches within niches. So, Ram, when you have the when, are you imagining a big bang that suddenly we wake up one day and everything is on the ledger, or niche development and then niche adoption?
I think the development will be not uniform across the globe. I see a lot more compelling arguments for adoption of blockchain technologies in countries where the financial systems are not as robust as in the Western world. And I think that's where you'll see a lot of action in the future.
Because you have less resistance to...
Less resistance, fewer alternatives, right? One of the fundamental questions is that, as Martin was pointing out earlier, if you are suggesting a disintermediated option, then the question becomes how cumbersome, how expensive is the current intermediated option. I think in the Western world, it's very hard to make that case. But in many of the other countries where the financial systems are not sound, I think it's much easier to make the case. So I think you'll see a lot of blockchain adoption in financial services in less developed countries than in US, UK, and other developed countries. So that's one bit of it. And the other bit that I'm optimistic about is that, as we talked about this early on, the fundamental driver is trying to disintermediate, not completely, but at least to the point where you can remove some of the inefficiencies in the system. The problem has always been that they also foster illegal activities. And I think the sweet spot in the next few years is going to be looking at opportunities in financial services where it's still legal, it's fully compliant. At the same time, it tries to get you the benefit of disintermediation. And I think that probably doesn't have a whole lot to do with currencies or money. It's more about processes in financial services. I could think of insurance, for example. There are lots of really excellent use cases for putting insurance and claims processes on the blockchain.
Mm-hmm.
Lots of really interesting and legal opportunities to lower the cost for AML and KYC by using blockchain. I think these are the kinds of applications that we'll see more and more of.
So, as in many other parts of technology, the less you have, the more likely the better position you are to sort of leapfrog
Exactly. Right.
the more developed. And we've seen that in payments in Kenya and India and other places. Martin, can you tell me what a financial world looks like where you have some elements tokenized and on the chain and some elements not? So some of my money is tokenized, my money.
To be frank, if you actually had a world like that where it was working, let's say, as smoothly as the current world, because potentially what you're talking about can actually cause a lot more friction, because it just means you have an additional way of settling a transaction or another way of moving money. You can see elements of this already as you get conventional finance supporting, for instance, crypto. Once you basically have some recognition of digital assets, whatever you call them, in the existing systems, which aren't going to go away, whether they're risk systems, finance systems, etc., it's just another entry in a database. And you also see this with the extent of things like, again, drawing on the crypto world, crypto custody. There's a custodian who handles all the messiness and the risk, etc., and then it just looks like just another line in your statement from your custodian. So based on how things have been progressing the last few years, with the crypto and some of the sort of emerging digital assets, in most ways it looks exactly the same as the current world, except where it's interacting with a different form of technology for recording ownership or settlement, etc.
So will a transition, and to be clear, when we were talking about some markets, not others, I think Martin and I both understood that we're talking about in country. So in the UK, having bond markets tokenized and on the chain and repo markets not. So how expensive would such a transition be, Martin, to support?
Most banks and large financial companies use companies called custodians. So they will look after your securities in multiple different markets, move them around, deal with corporate actions, etc. Now, one of the services they provide is they have actually built links to 50 different payment systems and 100 different security settlements depositories. So it will be not multiplicative, but it'll be additive. How do I build a link to JP Morgan's distributed ledger technology? Or if I'm a little bit more exciting, how do I build links to public Ethereum? So there will be additive costs to actually incorporate these additional ways of actually recording ownership and settlement. But it wouldn't be like you'd be multiplying it by a factor of 2, 3, 4, 5. It would be like, here's another 3 or 4 different ways I have to build to settle a bond transaction. So there would be additional costs, definitely, but it's on the margin rather than fundamentally changing the cost structure, either adding to, but it is adding to the cost base rather than taking away.
Yes. from those providers that are the same banks that are under threat, as it were, from.
Well,
so it might be easier for newcomers to build this stuff.
No, they'd still have to face the same costs, and also
it might be better at building it though.
Well, if you look at a lot of the work that, let's use the right term, intermediaries are doing at the moment, they're typically working in partnership with some kind of DLT focused company already. So it's not like there's a bunch of nimble people. And also a lot of this stuff is actually, because of the nature of it, it is actually surprisingly complicated and expensive if you're going to do it safely. So on anything on crypto on public blockchains, bearer assets are inherently a lot more risky than assets where it's just on a register and everyone knows, well, not everyone, but the relevant people know this is Natasha, and you lose your shares certificate, it doesn't matter. Bearer assets, someone, as we've seen in the crypto world over and over again, someone takes your crypto, there's nothing you can do about it. Someone sends it to the wrong address, there's nothing you can do about it.
Like cash.
And this is something the financial world has been moving away from for decades, and it actually simplifies things and makes things cheaper in some way. But if you go down that path where you're actually basically reintroducing bearer assets, it will add a lot of costs. And it doesn't matter how nimble you are, you can't get away from that if you want to manage that kind of thing in a safe environment and proper governance.
Ram, let's get back to your when. You mentioned earlier that I think, if I was to paraphrase, that it's maybe the legal, regulatory, governance type aspects that are holding us back. To what extent is the technological side or the skills side holding us back here?
One of the big challenges for a lot of banks is going to be just getting the tech talent to even pilot some of these projects. I think that talent is missing in the UK and more broadly. I think part of what we need to do as an education institution is to create the talent for the next generation, which is what we're trying to do. So talent shortage is certainly a huge issue. It also, as Martin points out, there are lots of other technical challenges that need to be overcome. For example, if you lose your secret key, all your assets are gone. So that's not a very robust way to manage your resources. So there are lots of technical issues that need to be overcome as well. But given the current state of the technology, given the current state of regulation, I still believe that there are very viable and useful applications of blockchain technologies in financial services. And in my view, a lot of them have to do with trying to make processes a lot more efficient and transparent to consumers. I think the sweet spot is at the moment.
And at the school and at the centre, how are you hearing? What brings you to work on a particular challenge? How close are we to industry in terms of understanding what these particular points are that we should be looking at, that students should be researching? So
I think in the center, in terms of the research that we do both what we call invention and also innovation. So invention is something more fundamental. So looking at the very underlying core aspects of cryptocurrencies, for example, or nature of a market. So those tend to be more theoretical at the moment, but long term they can have potentially huge implications. One strand of work, as I mentioned earlier, is about how can we create decentralized exchanges, crypto exchanges. I think that work is highly theoretical, but in the long run, it will have a huge impact. The second bit is around innovation, where we actually work with host of different startups in the fintech space or with the financial services organizations. There, the problems we tackle are defined by these organizations.
Ram, I think you've read some of Martin's and you've heard Martin speaking before. One of his great complaints, one of his most repeated complaints, is the lack of financial understanding that some of the technologists and fintech companies have. To what extent are you insistent at the school and in the centre of the convergence of these two areas and of ensuring that your students in the technology side understand a bit of finance and vice versa?
Well, this is a problem that is not just in finance, it cuts across. So whenever we have technology meeting business, then you always have these challenges that technologists don't understand business folks don't understand technology. And part of what business schools try and do is to make that interface as smooth as possible. With respect to we are about to launch an MSc in fintech. I think part of what we did was to go back to the fundamentals and design a curriculum that's ground up, that does justice to the domain knowledge, that does justice to technology, that does justice to all the other aspects, for example, compliance, legal aspects, marketing aspects, human aspects. All of that has to be imparted to students. So that's part of what we have done, and it took us a long time to come up with a curriculum that we are quite proud of. And this, I would say that at Warwick, we're trying to design a very robust MSc in fintech, and in some other places, just to be quick to market, people have introduced similar programs, but they're not very well thought through, and they're not very holistic.
So, Martin, in your career, you've sort of been in fintech, I suppose, and you're one of those rare people that sort of sits on that uncomfortable juncture between the two disciplines, which are, they're as separate in real life as they are in academia, or have been in academia, and as problematic, or if not more so. If you were a student now, or if you were speaking to a student, telling them what to do, what would you be telling them to do?
I'd tell them, if they want to actually be genuinely effective once they actually hit the labour force and actually make a real difference. And talking from a career which is mostly a practitioner rather than doing research, the thing I always found most satisfying was actually making a real difference to the organisation and my colleagues. There's three things you really need to understand if you're going to work in financial technology, which I honestly think the Gillmore Centre is actually trying to propagate. It's actually understanding, what does that technology actually need to do in a business sense? What does it need to do? What is credit intermediation? What's risk, and how do I manage it? What constraints that technology exists within? So technological constraints, regulatory constraints. And then the final thing is understanding of what problems are there out there in the existing world that I can be helped to solve. But connected to that is something which is actually more socio-economic than just technological, which again, I think is one of the things the Gillmore Centre is trying to bring out, is actually what obstacles are there to change and fixing things in the current world of financial technology. And that's where I think where the cross-disciplinary approach and bringing in things like economics and understanding people's incentives is really, really critical. So it's not just about the economics of the business, it's about the economics of organizations and how you actually go about doing change.
Organizations and people and ecosystems, and people within ecosystems.
Because they are all operating under incentives, they're all economic actors, and sometimes they are obstacles to actually doing things better. Often, if you find the right incentives, they are the catalyst to doing things in a much better way.
Well, I think you definitely sold me. You sold me both on the fintech MSc. I'm not sure, strictly speaking, that we've answered the question, how is blockchain going to revolutionize finance? I think we know that Ram thinks it's a question of when, and it might not be immediate and immediately profitable and universal, and we might see it in smaller pockets and smaller less developed jurisdiction. I think from Martin's corner, we're still seeing a lot of skepticism on the if.
Just based empirically, it's very incremental.
Well, isn't everything?
I think I will qualify my comment by saying not just when, but also where. And I think that it is not going to be uniform across the globe.
Just a last question. When one has read quite sensible publications that shouldn't have a particular bias towards one thing or another, and indeed, very, very biased research papers, it almost doesn't matter between them. There's a sort of euphoria that we had in the .com period, where everything was going to be on the internet and nothing would exist outside the internet. It was going to completely change everything, and Tesco wouldn't exist anymore. Well, guess what? Tesco's big and strong and still there. And in fact, it's the same supermarkets that we knew and loved before, and we still actually go into the physical stores. So is it likely that maybe it's a question of the best adapters will find a new way of doing what they were doing before?
I think there is this law called the Amara's law, which basically says that we tend to overestimate the impact of technology in the short run and underestimate the impact in the long run. So even taking the internet as an example, it has fundamentally changed things beyond what we could envision back in 2000. Yeah. So maybe we were pursuing wrong directions initially, but the extent of impact has been much more than what people were anticipating, even in the early euphoric days of the internet. I think something like this might happen with the whole crypto blockchain movement as well. But I would not be too quick to draw judgments, because one thing about blockchain technologies that is different is that adoption is a lot more challenging than in other technology settings. You need multiple parties not trusting each other to cooperate and find opportunities where everyone benefits. Those things are not easy. I think that's what takes more time. I think that's what will take more effort and creativity to find applications that are viable.
I mean, and maybe just to finish off, I mean, the fact that JP Morgan is managing to settle dollars against rupees itself, it's doing an internal transaction. It's not Citibank, JP Morgan, and ICBC all working nicely together.
That was I read about that, and it's literally you're just finding another way to message JP Morgan to move things around between JP Morgan accounts.
Yeah.
It's not actually revolutionary.
It is revolutionary in a sense, but the difficult challenge is creating that commonality of interest between the spread of organizations and countries in that particular case to make it happen. But with that, I know I'm on time. This podcast has got to come to an end. I think we've got to revisit this conversation and maybe take it off into various deeper depths. But for the meantime, thank you very much indeed, Ram and Martin. I hope that we get you back on this and other subjects. Thank you to you both. To you listeners, we'll be back with more episodes exploring the big issues in fintech. If you want to keep up to date with the latest research, thinking, and issues in fintech, be sure to sign up to our Core Insights newsletter, which will deliver all the analysis you need direct to your inbox. There's a link in the episode's notes where you can subscribe to the podcast and don't miss the next episode. So thank you for listening to this latest episode in Warwick Business School's Gillmore Centre for Financial Technologies podcast. Thank you.
Thank you.
Thank you.
Thank you both.